Welcome back to my channel, where we explore the most pressing financial topics to help you make informed decisions. Today, we're diving into a debate that's as old as investing itself: stock market versus real estate. Where to invest your wealth? This showdown between two of the most popular investment avenues promises to shed light on which path may be right for you. But before we dig in, don't forget to subscribe and hit that notification bell so you never miss out on our expert insights. Let's get started. To grow your wealth, which is the better strategy? Investing in real estate or building a portfolio of stocks? Many Americans do a bit of both. 65% of U.S. households are owner-occupied, according to the U.S. Census Bureau, and the Bureau of Labor Statistics says 52% of American workers participate in an employer retirement plan. If you're among them, you likely have some exposure to the stock market. But if you're looking to double down on either type of investment, or you're new to investing and trying to pick between the two, it's wise to know the advantages and disadvantages of each strategy. It's also important to know that you don't have to choose. You can purchase shares in real estate investments without the headaches of actually buying, managing, and selling properties. Investing in real estate. Traditional real estate investments can be broken down into two broad categories: residential properties, like your home, rental properties or flipping homes to buy, then resell for a profit, and commercial properties, such as apartment complexes, office buildings, and strip malls. The pros. Investing in real estate is easy to understand. While the home buying journey can be complicated, the basics are simple. Purchase a property, manage upkeep and tenants if you own additional properties beyond your residence, and attempt to resell for a higher value. Also, owning a tangible asset can make you feel more in control of your investment than buying slivers of ownership in companies through shares of stocks. Investing with debt is safer with real estate. Also known as your mortgage, you can invest in a new property with a 20% down payment or less and finance the rest of the property's cost. Investing in stocks with debt, known as margin trading, is extremely risky and strictly for experienced traders. Real estate investments can serve as a hedge against inflation. Real estate ownership is generally considered a hedge against inflation, as home values and rents typically increase with inflation. There can be tax advantages to property ownership. Homeowners can get tax benefits, like deducting mortgage interest and avoiding capital gains tax when selling their main home. If you sell commercial property, you may avoid capital gains tax with a 1031 exchange. Investment properties have tax breaks, too, through depreciation. Check a tax guide for more details. The cons. Real estate investments can be more work than stocks. Buying property may seem straightforward, but property ownership, especially rental properties, involves substantial sweat equity. It extends far beyond the initial purchase, demanding ongoing maintenance, tenant management, legal compliance, and associated costs. This contrasts with stock or mutual fund investments, which often require less hands-on effort. While real estate can offer diversification and potential for rental income, investors must be prepared for the time, effort, and financial commitment it entails. Choosing between property and traditional investments hinges on one's willingness and capacity to engage in property management and maintenance, not just financial objectives. Real estate is expensive and highly illiquid. Investing in real estate often needs a significant upfront investment and isn't as easily turned into cash as stocks. Selling or renting out property takes time and involves costs like agent fees and maintenance. Plus, real estate markets can be slow-moving. Unlike stocks, which can be sold quickly, real estate investments require patience, planning, and a long-term commitment. Real estate has high transaction costs. Sellers in the real estate market often face substantial closing costs, ranging from 6% to 10% of the sale price. These expenses can significantly reduce the proceeds from a sale. In contrast, the stock market has become more cost-efficient, with many brokers now offering fee-free stock trades. This discrepancy underscores the financial implications of selling real estate, as the associated cost can be substantial compared to the low or non-existent fees associated with stock transactions. It highlights the need for careful financial planning and consideration of expenses when entering or exiting the real estate market. It's difficult to diversify your investments with real estate. Location matters when investing in real estate. Sales may slump in one area, while values explode in another. Diversifying the purchase of real estate properties by location and type, a mix of residential and commercial, for example, requires much deeper pockets than the average investor has. The return of your investment isn't a sure thing. While property prices tend to rise over time, there's always a risk of selling a property at a loss. The 2008 financial crisis and post-pandemic uncertainty in the housing market are reminders of that. This is also true of stocks, of course. Investing in stocks. Buying shares of stock has significant pros and some important cons to remember before you take the plunge. The pros. Stocks are highly liquid. While investment cash can be locked up for years in real estate, the purchase or sale of public company shares can be done the moment you decide it's time to act. Unlike real estate, it's also easier to know the value of your investment at any time. It's easier to diversify your investment in stocks. Few people have the time, let alone the cash, to purchase enough real estate properties to cover a broad enough range of locations or industries to have true diversification. With stocks, it's possible to build a broad portfolio of companies and industries at a fraction of the time and cost of owning a diverse collection of properties. Perhaps the easiest way to get that diversification: purchase shares in mutual funds, index funds, or exchange-traded funds. These funds buy shares in a wide swath of companies, which can give fund investors instant diversification. There are fewer, if any, transaction fees with stocks. While you'll need to open a brokerage account to buy and sell stocks, the price war among discount brokers has reduced stock trading costs to $0 in most cases. Many brokers also offer a selection of no transaction fee mutual funds, index funds, and ETFs. You can grow your investment in tax-advantaged retirement accounts. Purchasing shares through an employer-sponsored retirement account like a 401 or through an individual retirement account can allow your investment to grow tax-deferred or even tax-free. The cons. Stock prices are much more volatile than real estate. The prices of stocks can move up and down much faster than real estate prices. That volatility can be stomach-churning unless you take a long view on the stocks and funds you purchase for your portfolio, meaning you plan to buy and hold despite volatility. Selling stocks may result in a capital gains tax. When you sell your stocks, you may have to pay a capital gains tax. If you held the stock for more than a year, however, you may qualify for taxes at a lower rate. Also, you may have to pay taxes on any stock dividends your portfolio paid out during the year. Stocks can trigger emotional decision-making. While you can buy and sell stocks more easily than real estate properties, that doesn't mean you should. When markets waver, investors often sell when a buy and hold strategy typically produces greater returns. Investors should take a long view of all investments, including building a stock portfolio. That wraps up our deep dive into the age-old question of stock market versus real estate, where to invest your wealth. We hope this video has provided valuable insights to help you make an informed decision about where to grow your financial nest egg. Remember, there's no one-size-fits-all answer. It ultimately depends on your goals, risk tolerance, and financial situation. If you found this video helpful, please give it a thumbs up, share it with your friends, and leave your thoughts in the comments below. Stay tuned for more financial wisdom right here on our channel. And until next time, happy investing.